I see a lot of people are joining. Hello, everyone. We're going to just wait a minute to start. We're going to start on time at 12 o'clock. Oh, it's now 12 o'clock. So I guess we can start. Yay. Let me just start. Everybody knows that this session is going to be recorded, and we'll be happy to share all the materials and the recording to everybody that is joining late. We have a lot to talk about today, but before, please allow me to thank you for your continuous participation. The Florida Bar section welcomes your attendance to all the presentations that we are organizing. As you know, today we have a great topic. We have Mr. Alan Gassman to present hot topics and best strategies for estate tax planning part 2. I know many of you have attended part 1 of this presentation, but if you have not attended that part 1, don't worry, we're going to share the presentation in our YouTube channel together with this session. And our CLE course code for today is 6076. Again, our code is 6076. But before we begin with this great presentation, we have a special guest today. Mr. Armando Ureña is here with us. Mr. Ureña is a senior partner and managing director of Snowden Lane Partners, a wealth management group. Mr. Ureña is representing this company that generously has been supporting our tax section. And I'd just like to take this opportunity to thank you, Mr. Ureña, because you and your support allows us to share these educational moments with all our members. And please, could you share a few words with us?
Yeah, thank you, Andrea. For those of you who we don't know, we're Snowden Lane Partners. We are a New York-based wealth management firm. Of course, we have offices in other places outside of New York. I and my team are in Coral Gables, Florida. We do traditional wealth management, investment management, trading, but are differentiated by our focus on planning, on estate planning, tax planning, on G2 conversations. These are things that we do not in replacing of the client's tax and estate planning advisors, but in conjunction with and working in coordination with clients outside advisors such as yourselves. With the tax section, we are very focused on the partnership, on not only bringing the financial resources that keep the lights on for you guys, but speakers and other value-added content that will hopefully make all of us better at what we do. Our next opportunity to do that will be at the fall meeting in Naples. So for those of you that I have not met, I hope to see you there. And we will be bringing on a presentation that I think will be very valuable to everyone around 1031 exchanges. So Andrea, thank you for the time. Thank you for the opportunity. And I look forward to seeing everybody in Naples. And in the meantime, of course, if you need to reach out, we're always available. Thank you.
Thank you so much. Thank you again. Okay, now without further delay, I would like to present Mr. Alan Gassman, somebody who needs no presentation. He has been helping us with other presentations, but just briefly, Mr. Gassman is a board-certified trust and estates lawyer and the founder of the Clearwater, Florida law firm of Gassman, Crotty Denicolo, PA, which is a 7-lawyer firm that focuses on representation of high net worth families, physicians, and business owners, and their companies in estate planning, taxation, and business and personal structuring. Personal asset structuring. Mr. Gassman holds a law degree and a master's of law degree in taxation from the University of Florida and a business degree from Rollin College. Mr. Gassman is a board certified by the Florida Bar Association in estate planning and trust law and was inducted into the Estate Planning Hall of Fame class of 2021 and has received the accredited estate planner designation for the National Association of Estate Planners and Counsel. And also he's a frequent speaker, he's an author of several books. And later today we'll have his partner, Mr. Brandon Kitron, also an estate planning attorney. He will join the presentation. He holds a Master's of Laws degree in taxation from the University of Florida. He's also a CPA, a certified public accountant, and frequent speaker and author of several articles. Without further ado, thank you so much, Mr. Gassman. Please take it away.
He also has a puppet who speaks. So today we're going to cover a lot of things. Gassman's not very good for presenter, but I will help him. Well, thank you very much. Well, thank you. All right. I hope that that was not the very best part of this presentation. Those of you who were able to watch part one without falling asleep did give me some comments, did give me some questions, and did ask me not to do part two because you had already heard enough, but part two has to come anyway. So let's start off. I'm assuming that you can see my screen, and I've got a checklist here of 15 planning strategies. I want to talk about 2 or 3 of them at least, because we may not get to all of them today. Brandon Ketron is going to join us in about 40 minutes, and he's going to cover qualified personal residence trusts. He's going to cover whether you should pay income tax on your IRA and convert the whole situation to a self-canceling installment note for clients with a short life expectancy. And the answer is sometimes yes. And Brandon is also going to talk to us about how to evaluate whether a client has already given too much away or what their comfort level will be with rates of return and the obligation to pay income tax on a grant or trust. Can they afford to give more away, or are they going to run out of assets? So here on the screen, I just want to mention, number one, if you've read the Boss trucking case, if you've thought about, well, this family has a very successful business and it keeps growing. Well, can the next generation under dynasty trusts open the new locations? Can they take advantage of the new business opportunities at arm's length to not add further assets to the part of the estate that is going to be subject to estate tax? And by the same token, if I had time, I'd do a new number 2. A lot of times you have clients who are just like brothers. I mean, they love each other. They've been in business with each other a long time, and they are willing to enter into buy-sell agreements with low side valuation language. So when one person dies, the other person buys them out, not for free, not as a gift, but at a lower value. And Section 2702 will permit that if it is using a valuation technique that is somewhat prevalent in the industry. So just a buy-sell agreement between unrelated parties can, or even sometimes between related parties, can help you to depress values and to suppress estate tax to have less depression of beneficiaries who have to pay estate tax. Number 3, the use of an irrevocable life insurance trust. And very often you look at an estate plan in existence and there is an irrevocable life insurance trust, but it has a problem. And the problem is it is not GST exempt, meaning mom and dad set up this beautiful life insurance trust, and when they die, it's going to pour all kinds of value onto the children's estate. So is it time to set up a new life insurance trust? And the old life insurance trust could place the life insurance policy into an LLC and sell the 99% non-voting member interest in that LLC to the new life insurance trust in exchange for a low interest note, believe it or not. And that can have fantastic implications. I also do not want to forget to mention split dollar. And the good news about split dollar is I don't have to use my $16,000 a year crummy withdrawal power ability to pay for life insurance premiums. I don't have to limit life insurance premiums to $16,000 a year per beneficiary. In many cases, it's much better that the client or an entity controlled by the client will advance the premiums to pay the life insurance needs using loan split dollar, which means I pay a premium this month, and if the policy is expected to last more than 9 years, I can use the long-term applicable federal rate, which is just over 3%. And the life insurance trust doesn't have to pay my client back until death or until the policy is ever cashed in. There's no annual interest payment. So when you run the numbers on split dollar life versus making gifts to a life insurance policy to make the premium payments, you will often find that split dollar is better. But then if you listen to one thing today, as if your significant other didn't tell you 2 or 3 things that you should have listened to, make sure you understand that under the Levine case and pursuant to section 2036A2, if you have a split dollar agreement, which says the parties hereto have the right to amend this agreement, then because your client would be needed to amend the agreement by the terms of the agreement, you have a 2036A2 issue, which could cause that life insurance policy to be subject to estate tax in your client's estate. So more than 3 years before your client dies, you need to amend that split dollar agreement to no longer say that it can be amended by unanimous consent. Now, this is very silly because under state law, any agreement can be amended by unanimous consent. But as the Levine case points out, the case law says it's okay if the right to amend comes by virtue of state law, but if the right to amend comes by reason of an agreement, then under section 2036A2, the ability to control what you gave away in conjunction with one or more people, even if they're adverse, can be a shot in the head, not a very good result at all. Number 6, are you discounting everything possible? Your client has all kinds of assets, and maybe you got excited about 1 or 2 of them, but if you put everything possible into discounting vehicles, co-ownerships, LLCs where you've given away the voting rights and only kept the non-voting rights, we want to make sure that all of that is happening. So other things on the list you see here that we are going to cover, make sure, as I said before, that you work to discount everything you can, to sell everything you can for low interest notes, to grat everything you can. Don't leave anything on that client's financial statement that is going to go up in value and cause undue federal estate tax. And homes and vacation homes are no exception, as Brandon and I will show you in about 30 minutes, which is 7/10 of a billable hour for many of you. I don't want to forget, there's an article that will come out in the Bloomberg B&A EGT journal on July 14th. And as I said here, don't tell B&A that I showed you this article, but it has been finalized. And I thank Marty Shinkman and Jonathan Blattmacher for doing a lot of the lifting in this article, because they are a delight. You can send them any information, any problem, and they have ways of solving it. But I'm concerned that eventually this new Florida statute, which gives us some opportunities, is going to cause some issues. And one reason for that is that the statute says that if I set up a SLAT for my spouse and I am not a beneficiary of that SLAT until after the death of my spouse, then after the death of my spouse, I can become a beneficiary and will not be considered to have been the contributor to that trust. Now, that doesn't mean that I should put in the trust agreement that I'm the grantor. It will be for the benefit of my spouse during my spouse's lifetime. And on my spouse's death, I'll be the primary beneficiary and be able to receive whatever the heck I really need, because this trust will really be for me at the time. That would be a big no-no, because notwithstanding that I will not be considered to be the contributor to that trust under Florida law if I do this correctly. If my expectation in contributing to a trust is that I will be a beneficiary if certain things happen, then under Section 2036A1, I have put assets into an arrangement and have retained an ability upon certain contingencies to be a beneficiary. So the trust needs to appear and be conducted, and communications need to clearly say, this is only a backup. I don't expect to ever receive anything from this trust. If I do ever receive anything from this trust, it'll only be in a situation of urgency, which is certainly not expected. The second thing that we've been struggling with is the exception creditor statute. So I put assets into a trust, and I'm not a beneficiary until after my spouse is deceased, but then I remarry. My first spouse is still a beneficiary of this trust, and I don't pay the alimony to my second spouse, or I have a child, I don't pay the child support, and son of a gun, the creditors can reach into the trust. Now, if the IRS sees that my creditors can reach into the trust, that I can go run up some debt, have a child, not pay child support, have it paid from this trust because I don't like my first spouse anyway, well, then is the IRS going to say that I retained an interest in the trust under 2036A1? And this is where I spoke to Marty and Jonathan about the exception creditor trust. And this is what we think will happen, or how this would work. Let's say that I'm going to set up a $10 million slat, and I do like the idea of being added as a beneficiary of that slat if my spouse dies, or putting that slat in Nevada, South Dakota, or Alaska now, or actually in an exception creditor state now, like Delaware, so that I can be added as a beneficiary if I have a financial reversal. Well, the concern is that the IRS comes in and says, well, you're in an exception creditor state like Florida, and therefore you could be considered a beneficiary from the time you set the trust up. So how about if you set up a $500,000 slat at the same time you set up a $9,500,000 slat, and the $500,000 slat says that the trustee will pay any exception creditor under any exception creditor situation from the $500,000 slat and never from the $9,500,000 slat. And under the $9,500,000 slat, the language says, if the $500,000 slat is ever down below $150,000, then the grantor of the $9,500,000 slat will be eliminated from being a potential beneficiary at any time whatsoever. So now you really don't have an ability to run up a lot of debt with an exception creditor and to have that exception creditor get paid. Because as soon as I'm eliminated as a potential beneficiary of the $9,500,000 slat, then my exception creditors cannot reach into it. So we call that the ECT trust. It's kind of a joke because ECT, if you want an et cetera trust, it's ETC, but you can remember it as the ECT trust. And we think it's something worth considering if you're concerned about the exception creditor situation. The other concern that I have, I think more than most, and maybe I'm off base here, but if I set up a slat and I can't be a beneficiary until after the death of my spouse, but the trustee has the ability to make distributions to me to reimburse me for the income tax that I owe as the result of the trust being disregarded for income tax purposes, well, that sure seems like I'm a beneficiary, doesn't it? So the question is, should there be a tax reimbursement clause at all? Our firm doesn't like tax reimbursement clauses. You basically have to break our arm to have us put in a tax reimbursement clause, because I'm just concerned that the IRS will see that as a retained interest, even though Revenue Ruling 2004-64 says that they won't unless there's other evidence. If you actually get the reimbursement, isn't that other evidence unless there was a change in circumstances? So I think it's safest in these slats to say that the tax reimbursement will not apply unless, except to the extent of taxes paid after the death of that beneficiary spouse, if you're trying to qualify this. So just words to the wise there. The drafting of these Florida slats under this new statute has to be very careful. There's more information in our materials, but just wanted to share that. In going through the slides that I was planning to cover today, I decided that there were 446 slides were not enough. So I added some other slides that I just wanted to share with you before I get into the main deck. This is a slide presentation that I am sending to a client today. And the client is very charitable. And there's about $60 million worth of assets already in Dynasty Trust that will never be subject to estate tax. And then the client and the client's spouse already still have about $15 million of exemption. So they could die and leave $75 million total into GST and non-GST trusts for their children. And anything above that is going to activate the federal estate tax at the 40% bracket, plus whatever estate tax bracket applies in the state where they live. So, you know, the first thing we say, which is pretty simple, is wouldn't you rather just have the excess go to a family foundation? And this could be a private foundation, a private operating foundation. It could be a public charity controlled by the clients if they don't want to have to worry about the self-dealing rules. And it's fairly easy to do this. You know, the clients die. That's probably the hard part. And then the document says, on the death of the survivor, the remaining assets that would be subject to estate tax, anything over the exemption amount, will go to a private foundation now existing or to be formed. You don't have to tell the name of the foundation. You don't have to have it formed before death. And you don't have to decide now whether it's going to be a private foundation, which is easier to operate and set up, or whether the family may want a public charity, which would not be subject to the self-dealing rules, such as setting up a school or a medical clinic that would qualify for a hospital, or a church or a supporting organization to a church. These are all pretty easy to do. You'd have 2 or 3 years after the client dies to set all this up and zero estate tax. Now, if there's a child, for example, maybe there's 2 children. One child says, no, pay the estate tax. I want my inheritance. I need the money. I'm normal. The other child says, you know, I'm on the fence here. I'm not sure if I'm going to want the money or if I would want it to go to a foundation that I can control. Well, the answer there is child 1's share goes to a non-GST trust probably. It's going to be subject to estate tax, but child 2's share goes to a trust where the trustee, other than child 2, has 9 months after the death of the parent to disclaim or reallocate some or all of the disposition to your community foundation. And if you've not gone and had lunch and met the people in your local community foundation, you really should, because they're very nice. They're all nice in community foundations. They're all well-meaning. They're all intelligent. And they're all willing to do whatever your clients want them to do with this inheritance that would come in under the parent's estate plan. So the child, then you could do a flat disclaimers provision or just do a trustee discretionary provision. Now, the next slide shows that instead, let's say the parent says, well, you know, I am charitable, but not so charitable. I want to make sure my children get as much as they possibly can. And that's where you say, well, would you rather pay 40% to the IRS or pay 0 to the IRS and have 40% go to a charity, 60% go to your children? And the client says, is that at all possible? And the answer is absolutely. You will set up a testamentary charitable lead trust, and whatever goes into the charitable lead trust, maybe there will be a 12-year or a 20-year payment to your private foundation. Your children will control the private foundation. What's left after the 20th year will go to non-GST trust for the children. There will be generation skipping tax issues when the children die. It will have to be subject to estate tax at their level. But here's another idea, and this is the next slide. It goes to an independent trustee, and the independent trustee confers with the children, confers with the tax advisors, and decides after death what portion goes to the charitable lead annuity trust and what portion goes directly to the private foundation. For example, if there's a lot of S corporation stock, then S corporation stock won't go into a charitable lead trust testamentary. You would lose your S election. S corporation stock doesn't go well into a private foundation either, because the unrelated business taxable income that comes through the S corp is both taxable, and too much of it will cause you to lose your exempt status. So the S corp becomes a C corp. There's a lot of thinking to do here. So the best answer is to give the flexibility. And the other thing, which I mentioned before, and I got questions on it, so I just want to mention it again, would be, well, no, I want my children to own the business. I would rather not pay estate tax, but I want my children to own the business. So what can we do? Well, we put an option agreement in place, which says that an existing dynasty trust or the children themselves have the option to buy the business. And then instead of the business passing to the private foundation, the note that the children give or the dynasty trust gives when it exercises the option goes to the foundation. And therefore, there is no estate tax. And instead of the children paying estate tax on a $100 million business, they owe $100 million to the private foundation, but at the applicable federal rate. And then if and when they convert the private foundation to a public charity by causing it to be a school or a medical research organization or one of those things, or get public support, then they could work a deal and buy that note out at a significant discount. So those are some charitable slides. And I wanted to show you some numbers here. Jerry Hesh and I worked on these numbers. If I have $10 million that will grow at 6% a year, and I do a zeroed out CLAT back when the applicable federal rate was 1.86%, if it was a 12-year straight payment CLAT, then at the end of the day, assuming a 6% rate of return, the charity got 15 million, the children got 4 million. So the children ended up with 28%, the charity ended up with 72%. That's a lot better than paying 40% to Uncle Sam, considering that they can control the charity. But if you use a 12-year CLAT where the payments increase by 20% a year, you don't have to use a shark fin CLAT. That's pretty aggressive, but you use a CLAT where the payments go up by 20% a year. Then when you run the numbers, the kids end up with 35%, the charity 65%. But if the kids can wait 20 years, which is a pretty good period of time, then the numbers on a flat 20-year payout, 45% to the children, 55% to the charity, or a 20% increase 57% to the children, 43% to the charity. But let's say that you can fund the CLAT with discounted dollars. So you put 15 million is in an LLC, the 99% non-voting member interest in the LLC goes into the CLAT on death, or you could do this by gift. And then you do a 12-year, 20% increase. Look at this. The children, present value of what the children receives, 59%. Present value of what the charity receives, 41%. And then if you go 20 years, the children present value gets 73%. The charity gets 27%. So, you know, when you say to your client, I think you should consider a charitable lead trust, they are just fantastic. You could push more than what your children would get after estate tax to your children. And what would go to Uncle Sam, less than that goes to the charity that your children can control. This is the best thing since sliced bread. If you say it to them that way, they're more likely to be interested in having you run numbers than if you say, well, there's something called a CLAD. It's very complicated. I can't really explain it right now, but a lot goes to charity. Your children wouldn't get it for 20 years. You know, you gotta just really get enthusiastic and get confident by running numbers to explain these things. Something else I was asked to re-explain, because I did such a terrible job of explaining it last time, not even the puppet understood it, is the clawback. So we have to start thinking about the clawback because of GST planning and because of portability planning, which most of us had not realized. So what is the clawback? The clawback is that in 2026, unless we have a president who agrees with a Senate and a House of Representatives, the estate tax exemption will go down from probably what will be about $14 million, the way inflation is running, to about $7 million. So clients are going to be rushing in 2025 to use up their $14 million exemption. So in 2025, I give $14 million, and then I die in 2027 after the exemption has gone down. And at that time, since I die after the exemption has gone down, when you work out my estate tax, do I get the whole 14 million exemption that existed when I made the gift? Or am I only getting 7 million and then my estate owes more of an estate tax? And when the IRS passed this legislation that became effective in 2012, they said, when Congress passed this, they said, well, the IRS will issue clawback regulations. And the IRS issued these clawback regulations, and they finished them out in proposed form this year. And what they did was they said, we have a special rule. See the smiley face? It's a good thing. And it says, if you give it away before 2026 and it's a normal gift, then you get to use the exemption. Well, what about a situation where I have $30 million in my IRA, I have my house, I don't have anything else to give. So I will give a trust for my children a $14 million promissory note in 2025. The note will be for good and valuable consideration. My children have to agree to read the first 14 pages of the book Catch-22. I hope they'll read the rest, but if they'll give me that consideration, the note will be enforceable. And then on my death, that will reduce my estate by 14 million. And the IRS says, no, unfortunately, you are now in one of the exceptions to the special rule. And if you're in the exception to the special rule, then you will be treated as if the exemption was only 7 million when you gave the gift of that promissory note, and that will be a very unpleasant thing. So now what do? Well, you give the promissory note, but you tell the client, we need to make sure that you actually pay the note before 2026 so that we can get out of the exception to the special rule. And then unfortunately, you have the 18-month rule, which is around here somewhere. And under the 18-month rule, you had to pay that note off within 18 months. So you would need to pay it off by June of 2024 in order to get out of the exception to the special rule. The other thing that they did was they said, look, if you put assets into a trust and it is a complete gift trust, so you use your $12 million exemption in 2022 to make a complete gift to a trust, and then that trust pays you income for your life. And as a result, when you die, the trust is in your estate under Section 2036. And the reason for doing that would be that I would be able to use up my $12 million gift exemption to get the trust funded. And then when I die in 2027, while the whole trust is in my estate, I would have been able to have used that 12 million exemption, which under Section 2043 still is there for you. And the service said, no, 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 that's not going to work. If you die after 2026 and you have a 2036A retained interest, then you're going to be back to only your $7 million exemption. So, wow, is that going to be painful? When people die with a 2036A retained interest after 2026, and they have to pay estate tax not only on the asset, but double estate tax on the bonus exemption that they lost, that's going to be very painful. But you're going to want to do those trusts anyway to lock in the GST exemption. And the reason is this: I put the 12 million into the grantor retained income trust. It pays me income for life, and I allocate my GST exemption to the grantor retained income trust. And as a result of that, when I die after 2026, even though I lose that bonus exemption and my estate pays more estate tax than it would have, I still have that income interest for life, which I insisted on keeping, and the whole grit can be GST exempt. Because see, when they did the clawback rule on the estate tax, the clawback rule does not apply to the GST exemption. And the other place where that's going to happen is your client was so sad when the spouse died and they got a $12 million portability allowance, and they were very sad. And then they got a little happier when they remarried. They remarried somebody who is wealthy and cares about them and is going to take care of their of the new spouse's children and not leave an exemption. So here I am with a $12 million, the $24 million exemption, and I'm likely to outlive my new spouse, and that's going to cause my portability allowance to come to zero. So before 2026, I gift that portability allowance amount to a grantor retained income trust, and $12 million. I keep the income interest because I insist on that. I want it. By the allocation rules, the first 12 million I gift is allocated to the portability allowance. Now I die under 2043, that portability allowance is still going to be there for me. So we have a couple more years before we need to activate this, but it's information that your biggest clients are going to want to know about. All right, so now I'm going to switch back to the PowerPoint that was distributed and talk about a few things here. I'm going to forward to the yellow slides. The applicable federal rate is going up fast. And you see the June rate for a 9-year or longer note, 3.22%. You see on page 68 here how these rates are quickly increasing. Now, if you do an installment sale, and maybe if you loan money, you can use the rate, the lowest rate of this month and the last 2 months. But look at this, we're at 3.22% now for July. If you can lock in your transaction now, you're going to be at 2.66% on long term, 2.51% at midterm. But if you wait until August, you're going to be at 3.11%. So getting these sales done, if you can, before the end of the month. Now, if you've got to fund an LLC and then get the sale done, you're running out of time. Because if you're going to fund an LLC with assets and then sell the 99% non-voting member interest, and you do it without leaving time between funding the LLC and making your sale, then under the step transaction doctrine, the IRS may take your discount away. But for most types of assets, 10 to 15 days should make it. You've got the case where the Dell stock was in the partnership for 8 days, and the IRS said that Dell stock was volatile enough to do that. Something that I do not have a slide on, but it certainly comes to mind, is I met with a client yesterday, virtually, of course, and his Bitcoin arrangement with the Bitcoin company that he invested in has locked up. So he has a $5 million income tax basis. He paid $5 million for this Bitcoin. When I started planning for him a month and a half ago, the Bitcoin was worth 30 million. And now the Bitcoin is worth unknown because it's frozen. The entity is in bankruptcy. And there's trillions, I believe, at least hundreds of billions of dollars in this situation. So we're going to transfer that ownership right in the frozen account to an LLC and transfer the non-voting member interest in that LLC to a dynasty trust right away while it's still frozen, while we can be plenty pessimistic. Now, what is that worth? You know, what is $10 million worth of Bitcoin that's frozen in a bankruptcy worth? It might be zero, or it might be 15 million. So reach out to the clients who have a lot of Bitcoin. We can't know whether this Bitcoin bubble was a permanent bubble, whether it's going away or not, but you can certainly sell it for an installment note. Which brings me to another planning point, and that is because of the precarious situation that I believe our economy is in. If I have a client with $100 million dynasty trust, $100 million dynasty trust, and he's going to do a $20 million sale of appreciated real estate into that dynasty trust for a $20 million note, I'm going to have him set up a new dynasty trust. I'm going to have him do a $2 million seed capital gift. And then I'm going to have that new dynasty trust buy the asset for the $20 million note. And the reason is this, and as we learned in the recession, if the asset goes down to 5 in value, then now he's owed $20 million from the $100 million dynasty trust. And basically, he has made a $15 million reverse transaction because he's still owed the 20 million. It's still in his estate for estate tax purposes. On the other hand, if he does a new slat with a $2 million capital contribution, he can terminate that slat when the asset dives down in value. Now he's only got 7 million in his estate, the value of the asset plus the 2 million in the slat. So we've reduced his taxable estate by 13 million. So maybe I didn't explain that so well. which happens often, I'm told. But again, if you're going to be selling assets and you can't be sure what their value is going to be, then it may be time not to do an installment sale to an existing well-funded trust, but start a new, less well-funded trust. They can always merge later. So Brandon, it's 15 till. Are you joining us? Meantime, I'll look for another slide in case he doesn't show up. I wanted to mention, while we decide whether Brandon's going to be joining us, will a Florida community property trust work to get you a stepped up basis on the death of a spouse? And the answer is, we hope so, but it is not clear whether the IRS is going to allow an elective community property statute to enable you to get your step up. So there were people who asked me to go a little bit slower on the concept of the joint exempt step-up trust. So let's say that I'm a neurosurgeon, I'm married to a soccer coach, and I want to use the entire $12,060,000 exemption if I die first, but I do not want to have exposure of loss of assets of any significant amount if I am sued. So I set up a joint exempt step-up trust with my spouse, and I own 1% of the trust as my share, and my spouse owns 99% as my spouse's share. And on my death, my share, which is only 1%, goes to Credit Shelter Trust A, which is a typical credit shelter trust. It benefits my spouse without being subject to estate tax in my spouse's estate. Now, let's say there's $20 million worth of assets in the trust. 99% of $20 million is worth more than 12 million. So on my death, I have a power to appoint the assets of my spouse's share up to $12,060,000 worth to credit shelter, to creditors of my estate. And only with the consent of any one of our neighbors to the right, to the left, or behind us. And those neighbors don't like me because of my loud music, so they would never give me consent. But nevertheless, it is an effective general power of appointment. So Brandon, welcome. So I die, and those assets that I had the power of appointment over go to a credit shelter trust for my spouse. And I am considered to be the contributor to that trust under a technical advisory memorandum and 3 private letter rulings. So even though I have a very small net worth, the 12 million goes into creditor trust B. And in our opinion, I use the word opinion, not in the official term. Normally, if you use the word opinion, you'll turn to ICE or something like that. But we believe that the way Credit Shelter Trust B is drafted, that not only will it be fully funded on death, but the assets will get a step up because my spouse cannot be a beneficiary of Credit Trust B until her own assets run out and independent trust protectors add her as a beneficiary to Creditor Trust B. Now, the IRS may not agree with this approach, but it is certainly, I think, worth considering as opposed to the community property trust, because if I put it in the community property trust, then my creditors can reach at least half of it or all of it, depending upon which state community property you want to use. So Brandon, are you there? I guess I should hit stop share here because I don't like to share anyway. And then we're going to share your screen, I heard.
Let's see, I think we can pull it up. Can you see it now?
I see it now. Absolutely.
All right. So Alan wanted me to pop on here and go over some of these recent spreadsheets that we've created. And we can send these out to you if you would like. We think they're pretty useful as far as just explaining things to clients. And they're not perfect, but I think they provide a good picture of what's going on. So the first one we created was really came about by a client that came to us that had just entered into an installment sale transaction and was concerned about the amount of assets that they would have left over after they sold assets to a trust. And so what we did was create this dynamic spreadsheet to show her that there'd probably be plenty left over. And even still, she might be subject to estate tax, so we might have to do some additional planning. But the scenario here was the client had $20 million left over. They put approximately $6.1 million of assets into an LLC and sold a non-voting membership interest in the LLC to a defective grantor trust in exchange for a note. There was around a 25% discount that applied in that situation. So she got roughly $4.58 million back. The note paid 1.74% interest. An alternative that we discussed was the ability to have a private annuity arrangement. So instead of a note, she would just receive an annual annuity of around $441,000 each year. She let us know that she would spend around $900,000, and we used a very conservative growth rate of 3%. So what does that look like? Well, we show here the beginning balance, the growth, the note payments each year. It was interest only for the first 19 years with a balloon payment in year 20, her annual spending, and then the balance here of what her estate would be looking like. So you can see at the end of the, how many ever years, 30 years, we went out to age 100, there was still plenty of assets left over. So the nice thing about this spreadsheet is we were able to have that conversation. She's like, well, what if I spend $1.5 million? Well, in that scenario, it's looking like you might run out of money. But we use a conservative growth rate, so we can bump up the growth rate to say 6%. At a 6% rate of return, there's still plenty of leftover, barely a little bit of estate tax owed at age 100. So you can use this to kind of explain to clients and decide what you want to sell, what you want to keep, move the variables up and down. And then you can also, like in this situation where we were a little bit short at 3% rate of return, we have this option here where we can convert the note payment to a private annuity payment. And in that scenario, the money lasts a little bit longer. Her estate's a little bit less, or sorry, a little bit more because of she's getting this annuity payment versus the note. And so that works well. We can also add on the far right here, what does this look like for the trust? And what are we doing there? And how is the estate tax savings working under the trust arrangement? So the beginning balance of the trust, the growth on the assets, the note payments being made, and then the net value of the trust, which is all would be outside of her estate for estate tax purposes. So we think this is a nice spreadsheet you can use to illustrate to clients in a simple kind of understanding what the transaction is for the installment sale, how it works, how it can save estate taxes, and the cash flow situation after you make the sale. So Alan, any comments or questions on that?
No, and everybody, we can send this spreadsheet to everyone so you can use it. Do you want to show them how you could show she could have converted the promissory note to a private annuity?
Yeah, so we had that variable here. So you can just turn on and off the note payment to a private annuity. So you see this column changes as I change the variable there. So if I enter in 1, we have the note payment, interest only. And then if I delete it, it converts to the private annuity. You would have to come up with this number independently based upon the value of assets being sold using some software that's commercially available. It's not something that automatically populates, but easy to calculate using commercial available software.
Right. And then of course the arrows are a really nice feature. Clients like it because then clients can go ahead and make these changes. But once we showed this client that we could convert the note to a private annuity, and that it would be very difficult for her to run out of money. Then she was in favor of going ahead and shifting more wealth into the grantor trust. And this certainly helps or shows that we documented that she understands that she's paying the income tax on the trust income, which is, an important thing to make sure that the client knows. Or of course, we could have showed her, or we discussed the possibility of toggling off. But, it was the estate tax that really wagged the dog on this one, and for good reason. And it's also a reminder that people do live until 100. She has a mother who I think is 99. She fully expects to live to 100, and she is spending $900,000 a year. So, but the other thing though, when you talk to them is, well, you realize that what you spend now on your children can come out of the trust. So what do you really spend just on yourself? Well, that was fortunately less than $900,000 a year. So do you want to show the Cupert slide now?
Yeah, let me blow this up a little bit so we can see it here. But this is a similar spreadsheet to the other one where we kind of show estate tax savings and how a Cupert works. So Alan, I don't know if you talked about a Cupert yet, or if I should do a brief.
No, but you have 4 minutes, so spend all the time you want.
All right. So the Cupert is essentially a way to put your residence into a trust. You retain the right to live there for a certain number of years. After that term of years is over, the house would be outside of your estate and you would pay rent to continue to use the home, which is a nice way to shift wealth because that rent payment's not going to be considered a gift that's being made. There is a gift that's made at the time of funding of the trust, but it's discounted because of that retained right to use the home. So just talking a little bit about the estate tax side, and on the far right here, we have the same click arrows. So, you have the value of the home, the amount of the gift tax exemption used on funding. So in this situation with around a $2 million home, around $950,000 of your gift tax exemption is used to fund the trust based upon an 8-year retained term. We have what the rent can be invested at once it's received, the growth of the home each year, the rent value as a percentage of the home value. We used 8% in our calculations, and then the length of the term. What we haven't been able to do is you have to look up the use of the gift tax exemption and manually insert that in, but you can use the arrows to click up and down and get pretty close to what that exemption use would be. So what does this look like on the far left from an estate tax standpoint? We show the value of the home growing, the retained term for 8 years with no rent being paid. If you die within the retained term, it doesn't really hurt or help anything from an estate tax standpoint. It's going to be included in your estate, but no harm, no foul, because you get a credit back for the use of the previous exemption. But if you survive 20 years, now we are continuing to pay rent for 12 years after that 8-year term, and you've reduced your estate by $6.2 million. We used a small exemption amount, and we're able to save $2.1 million of estate taxes after that 20 years by the assumptions that we have here in this. Another question that we get is, well, if I put this into a trust, don't I lose my step up when I die? And we think there's a possibility that the step up could still apply under a grant or trust, but let's assume that it didn't. If you die in the 8-year term, you'll get a step up because it's going to be included in your estate. But if you survive that term and you lose the step up, am I better off? Did I lose out because now I have to pay some income taxes when I sell the property, or am I better off because of the estate tax savings? And it's pretty clear from this spreadsheet, based upon our assumptions, that the estate tax savings do outweigh the loss of a step up if you do lose the step up. So we added this on the far right to just show that to the client to make them more comfortable with the transaction. Even if they do lose the step up, the estate taxes you save at a 40% rate compared to a 20% capital gains rate are much less. And we even used 28.8% in this scenario here for a client that was in a state with around an 8% or a 5%, I think, state tax rate plus the 3.8% Medicaid NIT tax as well. So even including all of that, the estate tax savings definitely outweigh the income tax savings. And we also added a column let's say it's tax at ordinary income for some reason, if they eliminate the preferential capital gains rate, are we still better off? And even in that scenario, you are, because remember, you only pay income tax to the extent of gain, and you pay estate tax on the entire value of the property. So this just showed that you can still benefit from the use of a CUPRT. Alan, anything to add there?
No, I think we're out of time. I just want to mention, if you're going to do a CUPRT in Florida, make sure that during the retained interest term, you have the right language to qualify for the homestead exemption. Send a copy of the CUPRT to the property appraiser so nobody gets surprised or upset if the property appraiser at first doesn't like it. They'll eventually like it. And then make sure that at the end of the CUPRT term, you substitute in a trustee other than the client, and immediately enter into a 98-year or longer lease at fair market value that can be terminated by either party, so that you can keep that homestead exemption going forward. That the Florida has been friendly with that. Secondly, on your Florida CUPRT, make sure that on the sale of the property during the CUPRT term, that it converts to an annuity trust, which would qualify as creditor proof under the Florida annuity statute. So Brandon, thank you very much for joining us and working on these spreadsheets. Andrea, thanks for letting us speak. It's back to you here, almost on time.
Yes, on time. Thank you so much once again, Armando Ureña, who has stayed with us during this whole hour. Thank you for your support. Thank you, Alan Gassman and Brandon Ketron, for the presentation. This is going to be available to you guys. And that's it for us today. Thank you one more time and have a wonderful day.
Take care.
Bye.